Hello and welcome to Virtual Investor Conferences. My name is Bob Power, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from White River Bankshares. Before I introduce our speakers, please note to submit your questions in the question box to the left of the slides. And all of today's presentations will be recorded and available for a 24/7 replay. At this point, I'm very pleased to welcome Brant Ward, President, Ed Riandow, CFO, Jeff Mayland, Chief Risk Officer, and Scott Sandlin, Chief Strategy Officer of White River Bankshares, which trades on the OTCQX Best Market under the symbol WRIV. Welcome, guys.
Thank you very much, Bob. I'm going to start off by giving it to Brant Ward, our president, to take you through a brief overview of White River Bankshares. Brant?
Great. Thanks, Scott. Well, thank you all for joining our virtual conference. We're excited here at White River Bankshares and Signature Bank to be able to present to you what we think is a really great company with really great growth attributes. So just to kind of give you a little background about where we've been, we were a de novo in 2005. We've grown from zero to $1 billion today. We de novoed in 05 in order to help serve the Northwest Arkansas community through private banking type activities and the focus on small business. And so we've enjoyed some really good growth, not only in our customer base, but also in Northwest Arkansas. But you'll also hear how we've diversified out of this area into some really good Arkansas markets. You'll hear about our long-term growth strategy, and then finally part of our fintech strategy. And so when you look at our company overview, we're mainly in North Arkansas with 2 locations in Brinkley, Arkansas. Our total assets at the end of March 31st was just over $1 billion. So we feel very good about our ability to have grown from zero to that mark in that amount of time. As with every bank that hits the $1 billion mark, we have put into place getting ready for fiducia and just looking at that next growth level as it pertains to our infrastructure and how we operate. Northwest Arkansas was our original locations. We acquired the Bank of Brinkley in 2007 and really focused on those until the last 18 months, where we've de novoed 3 new markets, Jonesboro, Harrison, and then one called Bunco C. But what I would like to highlight is that in the last month, we've made a strategic decision to change the management team structure to really think about how do we grow from here. So we had a structure in place from zero to $1 billion. And now as we think about geography changes and really moving into that upper weight class for banks, we have promoted 2 new individuals to good roles. Alex Gladden to the COO position, which was previously my position, and Crandall Street to the Chief Administrative Officer role. And both of those roles are focused on getting us prepared to move to the next level so that as we scale, we can scale efficiently and effectively so that we can manage risk. When you look at the next slide with our proximity to metro markets, our ability to get to any major metro market is 2 hours to 5.5 hours. So we're really centered very well in the middle and the heart of America. When I talk about our North Arkansas expansion, we're really talking about Harrison and Jonesboro. So to start with Harrison, that is a town that we have over 300 shareholders in. So it's a natural fit for us to go into and really be able to have good customer interaction and already have kind of a book of business built. It is a place where you have banks that are continuing to get bigger, that are struggling to service the client that would be the way that we typically service. And then you have smaller banks that are attempting to come into the market and service those clients that are really not able to do that. So it's really a good sweet spot for us from not only a shareholder perspective, but a customer perspective. And then when you go to Jonesboro in the northeast corner, it's really the centralized hub of Northeast Arkansas. There's great growth opportunity, great companies there. But again, it's the same look where you have big banks getting bigger and small banks that can't really service the customers that we look to service. So our model is really centered on one-on-one advisement of clients and being able to meet their needs. And so when we think about banks that are 20 billion and rolling up into 50 and 100 billion, that really fits our model as being able to garner those customers and really being able to service them well. So I feel like in both markets, we have really good upside. We've got two really good teams there with seasoned bankers that are allowing us to make those moves. So we've had good, really good growth on both loans and deposits. Even in the face of a rising interest rate, we've had good assets being booked and really a good focus on deposits. And when I look at our third location, that's a de novo since September of last year, is our Hispanic and Latino focused bank called Banco C. So it's a division of Signature Bank of Arkansas. It is focused on corporate executives, private banking of our Hispanic and Latino folks in Northwest Arkansas, and then also the small business owners. And so we estimate there to be around 200,000 Hispanic and Latino people in Northwest Arkansas. And so this is really the first bank to focus on them as a whole. So our location is staffed with all Hispanic and Latino folks. They can speak English or Spanish, whatever is comfortable. And what we found is that, you know, a first generation Hispanic person may want to talk in Spanish because that's what they're most comfortable in. But when you have an executive at Walmart that is more comfortable talking in English, they can enjoy going whichever language they would like to do. And so that's really been one of our cornerstones around finding new markets, is really finding places that are underserved and that we can bring our private banking and small business model to help those customers. When you look at our deposit market share, we're up to number 5 in Northwest Arkansas. We're up to 26 in the Arkansas market share. We continue to climb that board because deposits have been a heavy focus. We've had significant strategy put around deposits over the last 7 years, and that really helped us as we went into COVID, as, again, the bigger banks struggled to really be good advisors and good helpers of their customers as they closed lobbies and were trying to force people through drive-throughs, and we were set up to onboard those people that we've been talking with for years electronically. So we really lead with technology and treasury management on the small business side, and that has helped us continue to move up the board on market share in both Northwest Arkansas and Arkansas. And then when we come to our original market, Northwest Arkansas, there is tremendous growth happening here. It is the headquarters of Walmart, Tyson, J.B. Hunt. The University of Arkansas is here. And so when we think about our area and the move where we crested over 500,000 people in Northwest Arkansas, moving to somewhere around 600,000, but really on a path to have 1 million people in our MSA, that really breeds the customers that we're really focused on. More small business, really focusing on commercial real estate, and that really is going to play into our hands. And again, the theme is we have banks here that continue to get bigger that are struggling to service the customers that we really service. And so we're doing very well in that space. Northwest Arkansas MSA is projected to be the 9th fastest growing market in the Southeast. We continue to have really good housing demand, and that's really focused on the amount of people that continue to move here. And it's not just for one company. We have people that move here as companies that service the big corporations, so Walmart, Tyson, J.B. Hunt. So we continue to have remote workers come. It's just really been a focus of the area to grow the amenities in this area. And finally, our fintech strategy. We went through a core conversion at the end of 2021. That was really centered around getting ourselves to an open banking platform, and so that we can plug in fintechs as we see them. The strategy really boils down to automating the back end and getting waste and paper out of the back end, and then enhancing the customer experience through digital banking. Those are the two things that we are very focused on, and this move allowed us to set up for that as we go forward, because really we don't know what's coming at us in the next 5 and 10 years, but we need to be ready to be able to plug it in when it's here. And so that was the goal and the focus that we've had there. And with that, I'll turn it over to Ed for the financial highlights.
Thanks, Brent. If you look at slide 14, you can see that the last 2 years for White River Bankshares have been very strong. With the interest rate environment, you can see the Q4 of last year and now the first quarter of this year, there's been an impact. White River Bankshares net income for Q1 of 2023 was $340,000. The primary driver is the lower net interest income due to the higher cost of funds. The ongoing Fed rate increases have resulted in some net interest margin compression. In addition, the repricing of loans is slower, causing loan yields to lag behind funding costs, but we expect this to stabilize over the course of the year. Our secondary mortgage business continues to struggle as rates have increased and the pipeline has slowed down. Salary and benefit costs have increased due to wage competition, along with hiring in new markets established in the past 2 years. We are pleased at how the new locations are growing our customer base and providing deposits despite this challenging and competitive market. If you look at the next slide, on slide 15, as Brant mentioned, our total assets have surpassed the $1 billion mark in Q1 of 2023, as loans and investments have continued to grow, while securing additional funding was also a priority, providing us additional cash. Net loans have increased 23% over the same quarter in prior year, although we have seen the pace slow down in recent months as compared to prior year growth. And our deposits increased 15% over a year ago, primarily driven by our time deposits. And now I want to turn this over to Jeff Malin.
Thank you, Ed. When you look at the loan mix slide, you can see, I think the first thing that stands out to me is we're predominantly a real estate heavy bank. That's mostly a function of two things. We are a community bank, and that's the typical space for a community bank to be involved in real estate lending in the markets. And then we're blessed to be here in Northwest Arkansas. The majority of our assets are located in Northwest Arkansas. It's a vibrant, growing community with tremendous opportunity for lending on the real estate side. And as Ed touched on, when you look back in 2022, we were able to grow that loan portfolio over $140 million, which for a bank our size is just tremendous growth. As far as the mix goes, you can see 25% in 1 to 4 family. That'll be a mix of primary residence loans to people that maybe don't fit the box for the secondary market or don't want to go that route for whatever reason, and then a good mix of residential rentals, which is a very healthy market in Northwest Arkansas. Beyond that, we are definitely an active participant in the CRE market. Again, that's a function of what's available here in Northwest Arkansas in our market. We feel like we have an expertise in that style of lending. We've participated in that market for a decade plus very heavily. We pride ourselves on knowing our customer, knowing our markets. We can drive by projects, see them, talk to our customers, and have a really good handle on what's going on in that market. So, we're really excited about the new markets we brought on and the opportunities we have to continue to participate in different types of lending as those markets allow. We think we've got great opportunities to continue to grow our loan portfolio, and we're also heavily concentrated on increasing that yield that you can see there at 5.18. We do have a relatively short loan portfolio in terms of duration, and we have lots of opportunity to reprice loans, and so we're excited to get the opportunity to increase that yield. So with that, I'll toss it back to Brant Ward.
Thank you, Jeff. So as we look at our funding mix, we, like I said, about 7 years ago, put a heavy emphasis on deposit growth, and particularly growing the relationship so that we have a full relationship. And that's really paid dividends for us over the last 7 years. We continue to get better, and we're not finished, but we are driving in the right direction. And when we look at our new net new account growth over the last year, we're up 14%. And as we assess other peer banks, they're down around 2%. So when I think about the growth in deposits, the balances will come. It's really about focusing on the individual accounts and every day blocking and tackling to bring those in. We're seeing that in the new markets. We're seeing that in our mature markets. And so we have a very heavy focus around the deposits and growing that. So like I said, through COVID, we had a very good deposit growth, and that has continued into the next couple of years. We're really seeing the fruits of our strategy and our drive coming home in deposits. And with that, we'll look at net interest margin. And as Ed alluded to, cost of funds has come up. That's no surprise to any bank in America. But what we do have, as Jeff said, is a shorter duration on the asset side. And so we are continuing to book loan yields higher than where we've been. We are seeing some migration of money market into time deposit, but that, again, is what we believe as every bank. And so really it comes back to the way that we're going to manage cost of funds is through continuing to grow relationships and then also getting a chance to reprice those assets. And so we're focused on that and doing that and going well. With that, I'll turn it back to Jeff Maitland.
Thanks, Brant. This is a relatively easy slide to talk about, the credit quality trends. Obviously, the graph tells the story there. If you look back the end of 2021, we were just about $1 million in non-performing assets. Got that down to $153,000 at the end of 2022, and we sat at the end of the first quarter at $124,000 in non-accrual loans with no ORE. That $124,000 represents one individual credit secured by a residential property that we're working through the process now and hope to have resolved in the coming months. I think we've been blessed with great growth, and our people have done a wonderful job of underwriting the loans and putting on good quality assets for the bank. That this graph certainly tells that story, and we've also been the benefactor of a wonderful economy. We're acutely aware of the recessionary possibilities in 2023. We are a CECL adopter in the first quarter of this year, and so obviously the forecasting piece of that is a heavy piece. And we've been fortunate thus far. We really haven't seen a deterioration of asset quality, but it's something that's at the forefront of our mind as we work through this year. And we'll react as necessary. And I think the one thing we've done a much better job of in the last 5 years as compared to maybe the 10 before is being proactive with credit issues, being aggressive in resolving them. And I think this graph tells that story really well. With that, I'll turn it back to Scott.
All right. Talking about building shareholder value, if you look at the tangible book value per share there, you can kind of see what we've been up to feel very confident in our ability to continue to see that grow over time. But I guess when you look at the earnings per share, I want to talk just a little bit about that. As you heard Brant and the team allude to, we've shown some good performance. In between 21 and 22, we did a lot of reinvesting. And we adopted a new core, which had a cost associated with it. But more importantly, we opened three new locations. And we're really proud about those results, and we feel like that we're poised to really build this organization significantly. As you also heard Brant talk about, we've kind of restructured for that next level of growth, and we're prepared to really see how much we can do as the business grows. So very excited about the future, very excited about where the bank is and the markets that we're serving. We'll continue to look at other markets as we grow. The next slide talks about kind of our primary strategy or primary goals. Obviously, increasing shareholder value remains something that we're focused on. You heard me talk about growth. We're always looking at the North Arkansas area, making sure that we're serving the customers well in the markets that we're in, and also looking at, are there other markets similar to the markets that we're in that we'd like to serve. So I would tell you that we'll continue to look at market expansion. Obviously, digital focus will remain a top priority for us as we look at really applying the digital aspect to banking since customers are starting to really adopt that and use that in a big way since COVID. Low-cost deposits will also remain a very top priority for us. We believe that is what a lot of the successes that we've seen thus far have come from that strategy, and we'll continue to focus on building our low-cost deposits, primarily with small businesses, and as you heard Brant talk about, with servicing our customers in the way that big banks choose not to. You're not going to find an automated phone tree here at Signature. We really believe in having that good relationship, old-fashioned banking business. Obviously, our diversified loan portfolio will continue to focus on looking at that and making sure that we focus on it. We are in a high-growth area, so it's obviously concentrated in land and homes, and we'll continue to do well there. But as we grow our businesses, that will help us in that area. Another area that we're focused on is, as you look towards the future, is focusing on efficiency improvements. You have to do things more efficiently. You need to continue to utilize technology where you can and control your costs. That is something that is important to us, something that we're going to spend time looking at and focusing on. And with that, I'll turn it over and we'll answer a few questions. So I see some questions that pop up here, and then we'll kind of look at who in the room might be the most appropriate to answer the question. But I'll start by reading the first question that I see. What are the growth drivers of the bank over the next few years beyond population growth in your market? Brant, you want to take that one?
Yeah. So our growth drivers for the bank are really centered around our people going out and producing on the private banking and small business level. So even without the growth population that we see coming, we're going to be able to take market share from other banks just because we're doing this in a better fashion and a more technologically way. And so that is really our focus, and that's our ability to win in market, and that scales across every market we're in. So I wouldn't say that certainly the population growth helps, and that's going to spur new business, but even without that, we would still take market share.
Next question. Can you speak to how you are managing the interest rate risk and depositors seeking higher rates?
Yeah, I'll take that. So our strategy has been to deal with the people that are looking for the really high rates in a one-off fashion. So we've tried to keep time deposit costs low through renewals. We've tried to keep money market rates low for the people that are willing to be there. And then we've negotiated one-off. Honestly, the first 100 basis point rise, we were able to not really pass much cost of funds on. But then the next 200 basis point rise, we had to do a little more work. And so it's a very targeted approach. We use Darling Consulting to run our interest rate risk model, So we're very in tune with the behavior of the balance sheet and the behavior of potential interest rate movements. We have a significant focus around that and are really dialed into how we manage the cost of funds as the Fed makes changes.
The next question is, what is your dividend policy, and do you have an active buyback program? I'll take that one. So we have an annual cash dividend program that we've instituted a couple years back. We've actually had 2 cash dividends so far. Expect another one coming this year. As it relates to the stock repurchase program or buyback program, we have a program. It was on pause. I will tell you, there's a lot of discussion right now about looking at re-implementing that. More to come as time goes by, but I would tell you that seems to be, when you have your stock selling obviously below tangible book, it's something that is probably prudent, something that we would look at, and we will be doing that. Next question, what is the current level of uninsured deposits as of May 1st?
So our uninsured deposits have hung around 30% of total. We were when Signature Bank of New York had their issues, that obviously bled into some of our customer base just to ask questions. Are you affiliated with Signature Bank of New York? Obviously we're not, but it was a good chance for us to call all of our larger depositors and really have a conversation with them. Most were very understanding around, we know that you're not affiliated, but we really appreciate the phone call. But as we look at that 30%, really it's a lot of good relationships. And so I think that's the advantage of where we are right now is, as you think about 30% uninsured, really we have a good chance there to really talk to all those people. We also have the Cedars and the ICS products that if somebody were to be really looking for full insurance, we're able to make that happen. But for the most part, those uninsured depositors have been very good with us and very understanding around SVB, Signature Bank of New York, and that we're just not in that kind of space.
Next question, any earnings per share expectations or analyst expectations for 23-24? And then there's a second part of that question, any thoughts on stock splits in 23 to help stock liquidity? I'll take that one. Obviously, we feel like the back half of the year from earnings per share is going to be better than the first half of the year. There were obviously a lot of provisions on what Brant was just talking about. As it relates to a stock split or something along those lines, I will tell you from a board perspective, those are questions that we look at and talk about frequently. It's something that we've been, trying to understand and figure out what is the best thing for Signature Bank of Arkansas to do. So it's something that we'll continue to talk about and let the street know when we're ready to tell the street. With that, I believe we're out of questions and we're about out of time. So thank you very much and appreciate the time to speak to you this morning, and have a good day.